All right, everyone. I'm making an extra video. This is not a normal video I send out. This is not going to be on YouTube. I'm just going to send it in a link. It's a video going over a very similar problem to the homework assignment we had in week 2. The reason is there's just a lot of differences and little issues here and there for the assignment, and I want to go over something similar just to show how to go about it. Now, I sent out a few other videos on how to make journal entries and do the postings to the ledger and then build the trial balance from there. Accounting is hard. We know that. There's aspects of accounting, such as choosing what account is affected by a transaction, where, yeah, there is room for error because it's a little more difficult. But there are some aspects where it's just here's a rule, follow the rule. That's when it comes to things like debits and credits on the journal entry. Things I've said in other videos where if I tell you each journal entry needs a debit and at least one credit, and the totals have to match, and that you put the debits on top shifted to the left and credits on the bottom shifted to the right, there's nothing to misconstrue there. That's just a rule. That's not figuring out, does this specific transaction have to have the credit on the left or the right? No. Debits in journal entries will always be on the left, credits will always be on the right. Every single journal entry will always have at least one debit and at least one credit entry. There'll never be a journal entry with just a debit. There'll never be a journal entry with just a credit. The totals, the dollar amount totals of those debits, if you have 50 accounts being debited for one transaction and only one account being credited, when you add up all those debit accounts, they're going to total the same amount as that credit account. If they don't, it's wrong. Something is off. This is a check and balance for accounting. It comes with its own built-in checks and balances. Now, if when you're doing your debits and credits, a transaction involves debiting cash, but you put accounts receivable, that's understandable. You're learning the accounts, what they mean, what should be debited here, what should be credited there. That is totally understandable. And I am much more loose on those because I know that's a learning curve. But things I tell you, like just take this one journal entry and make sure the debit equals the credit and that the ones on the left and the ones on the right, that's nothing to be iffy about. That's just a rule. Okay? And that goes with taking the journal entries and posting them to the ledger. If I have a video showing you exactly what you're doing here, and then how do you take what's over here and put it here, and then how do you take what's over here and put it to the trial balance, watch it a million times if you have to. Watch it when you do the homework. That's not cheating. There's nothing wrong with that. Watch it and take it step by step. If I'm doing it in the practice video, pause after I do one transaction, go and try one transaction on your own and go through and do it. So I'm going to go through. This is a very similar assignment to number 1. I literally changed just dollar amounts. Again, I never send this out. I don't normally do this. You're not going to see it on YouTube, so save the email I send it in. But I'm going to go through 13 transactions and I'm going to put it through the whole entire problem. So number 1, Janet Younger started a business using 500,000 of her own money. Younger opened a checking account and deposited all the funds there. So whenever an owner opens their own business and they put money into the business, that's what Janet is doing. She's putting 500,000 into her business. Her business will be receiving cash. So from the business's point of view, not Janet. Janet's just the owner. We're thinking of a business. We are a business. The business is going to receive cash. So we're going to put cash there near number 1. Shift it to the left. Cash is an asset. Remember the cheat sheet video. I'm not bringing up the cheat sheet here. You have the other video. Cash is an asset. It's increasing. When an asset increases, we debit it. So we're going to put that 500,000 in the debit column. Okay, I'm just going to turn this all into money so it looks nicer. So the business received cash of 500,000. But as you saw in the other videos, and as I told at the start, all journal entries need a debit and a credit. Okay, it has to balance that initial accounting equation. Assets equals liabilities plus owner's equity. Okay, so if you just debit assets here, okay, your equation's not going to balance because now assets are increasing. Cash is an asset. Assets are increasing 500,000, but nothing's happening to liabilities or owner's equity. So if one side of an equation increases, but nothing happens to the other side, it doesn't balance. So what happens here when an owner puts money into their business, it's called capital. So what we're going to have is owner's capital. And owner's capital is going to be credited for 500,000. Do you see? This is a journal entry right here. This setup should never be different. It's not the end of the world if you put credits on top and debits on the bottom, as long as the debits are shifted to the left, credits to the right. But really, to keep it neat and to keep yourself organized, start with debits. Debits on the top, shifted to the left. If you have 10 accounts being debited, 10 accounts on the top, shifted to the left. Then do your credit account on the bottom, shifted to the right. Okay, so again, owner's capital. When capital increases, so this is it. Janice is the owner, so this is her capital. This is what she owns as part of the business. Her capital balance increased 500,000. When owner's capital increases, you credit it. Capital increases with a credit. Okay, check out that cheat sheet. Check out the video with it. It shows you the little chart of debits and credits, what affects each type of an account. Does it increase it or decrease it? Number two, Younger purchased 7,000 of equipment and paid cash. Okay, so this Younger for her business is purchasing $7,000 worth of equipment. So equipment is an asset. So what we're going to do is we're going to start a journal entry. We're going to debit equipment, $7,000. So the total value of equipment, that resource to the company, that's why it's an asset. Equipment is a resource to the company, just increased $7,000. And the problem said she's paying cash for it. So cash is an asset. When you are paying cash for something, you're losing cash. So cash is decreasing. So for an asset to decrease, which cash is, we credit it. So there we go. We got our debits on top, shifted to the left, credits on the bottom, shifted to the right. And we have two accounts, one account being debited, one being credited. You could debit and credit an asset. I never said you can't do two of the same type of an account. So asset is the category. If you look at this, the accounting equation, assets equal liabilities plus owner's equity, assets are increasing $7,000 on the left side of that equation, but then they're decreasing $7,000 on the left side of the equation. So it cancels out. Up here, when we did cash and owner's capital, the left side of the equation, assets increased 500,000, but then the right side, owner's equity, owner's capital is part of owner's equity, increased 500,000. So it balanced. All right, number three. Younger purchased $4,000 more equipment on account. Office Plus extended her credit for the new computer. So we're buying more equipment, but it's being put on account. This is the key word. When you see on account or put on credit, it means cash is not being exchanged yet. So the placeholder, when you are a business and you buy something, is account payable. Account payable is a liability that signifies that you owe someone money in the future. So Younger is buying $4,000 more of equipment. So we're going to increase equipment, $4,000. By debiting it, it's an asset, and then we're going to recognize this liability, account payable, $4,000. Liabilities, when you're increasing them, so when you're taking on more debt, they increase with a credit. Number four, Younger hired 2 new employees at a salary of $48,000 each. I left that one alone, and the reason I left it alone is because we don't do anything with number four. I don't make the assignments for this class. Herzing makes them and puts them in, and then I just have to kind of live with them. I don't like that number four exists because it is a trick, and it shouldn't be there this early. I'm not a fan of number four. That's why I never grade number four. If you put number four a journal entry, I don't mark it wrong. I don't take off points because it is a trick and it shouldn't be there. What this is telling us, though, just so you have an FYI as to why it exists, Younger hired 2 new employees at a salary of $48,000 each. That's all it's saying is they just hired 2 new employees. This is what their salary is going to be. They're not being paid their salary. They haven't worked yet. They just got hired. So we don't owe them money. There's no liability with them. It's just here's a random statement to trick you. So number 4 has no entry. And I'll just write it here for your use. Number 5, younger purchase supplies for $1,500 in cash. So supplies are another asset. Think of equipment. You're purchasing a resource to use for the company. Younger, the business purchased supplies for $1,500 in cash. So we're going to debit supplies, 1,500, and it says right there they were purchased with cash. So we're spending cash. Cash is decreasing. We're going to credit cash, 1,500. Number 6, Younger paid $500 in cash to Office Plus for the computer. So this is where you got to look. On transaction 3, we purchased $4,000 of equipment to Office Plus, from Office Plus, and they extended us credit. So now in number 6, we're paying $500 in cash to Office Plus for the computer. So think if you had a credit card and you bought a computer for $4,000, put it on a credit card, and now you're just paying off $500 of your balance owed. That's what's happening here. So in number 3, we never paid cash. We put it on account payable. And again, account payable means we owe cash in the future. Now we're paying $500 of cash towards this. So what we have to do is reduce this liability first. So what we're saying is, okay, we initially owed $4,000 of account payable, but now we're going to reduce it by $500. So to reduce the liability, you debit it. So we're going to debit accounts payable, $500. And then how are we reducing it? We're paying cash. So cash is an asset. When you pay your credit card bill, you reduce your cash balance. Liabilities, accounts payable, decrease with a debit. So when you're decreasing the liability you owe, you debit it. All right, number 7. Younger rented office space, paying $5,000 in rent for January. Now we're in the adjusted trial, the accrual adjusting entries week, but this specific one does not have to do with adjusting entries. All it is saying is it's January and we're paying the rent we owe for January. So when you're just paying the rent you owe, it's a rent expense. Expenses, when you pay them, are debited. And whenever you pay an expense, even if it doesn't say in cash specifically, expenses are generally always paid in cash. So rent is an expense. We're going to debit it to recognize it, and we're going to credit cash to show the cash is decreasing. And what I say, 5,000, I believe. So we're going to debit rent expense. Expenses are debited when you pay them. We're going to credit cash to show we're paying out cash. Yep, 5,000. Number 8, we received $50,000 in cash for services provided to customers or to clients. All right. So when you receive cash for making a sale of goods or providing services, you're receiving cash and you're earning revenue. Okay. It's what the business is meant to do, earn revenue. So we're receiving cash of $50,000. Cash is an asset. So we're going to debit it for $50,000. When you earn revenue, you credit revenue. So whenever revenue is being earned, it's credited. Now there's different terms for revenue. You look at this assignment, it has sales. You could just put sales. You could put sales revenue. You could put fees earned. That's another term for revenue. You put whatever you want to really specify it's a revenue. I just go with sales revenue for more specific. All right, so now we're going to credit $50,000. Okay. Number 9, performed more services for $16,000 and agreed the customer, Mo, could pay in 2 weeks. So what does that mean? That means Mo is not paying us cash today for these services. So this is the opposite of number 3. This is we're providing services, we're providing something to the customer, but they're not paying us yet. They have to pay us in the future. But since we're providing the services, we still earn revenue. So we're going to wind up crediting more sales revenue for $16,000. But first, we're going to recognize accounts receivable. And again, accounts receivable is a placeholder for cash, and it means that we're going to receive $16,000 from this customer at some point in the future. So we debit it. Accounts receivable is an asset. It's a resource. It means money is coming in the future. Then we're going to credit sales revenue again. We're going to credit $16,000 because we're still earning the revenue. You recognize revenue whenever it is earned. So we provide the services to customer, we recognize the revenue. Number 10, Mo sent in a check for $10,000 on the balance owed. So now this is Mo paying off part of what he owes us. So he's sending in a check for $10,000. A check is cash. So we're receiving cash for $10,000. And what we have to do now is reduce this account receivable, this placeholder. We have to say, okay, he's not going to wind us. He initially owed us $16,000. Now he's paying $10,000 of that off. So we have to reduce it by $10,000. Okay. Number 11, the firm paid salaries of $18,000 for the month. So now this is telling us the firm paid salaries. Okay. It's not telling us new people were hired. It's actually saying they were paid. So salaries are an expense. So you could debit salary expense, you could debit wage expense. They mean the same thing. Anything to show you're paying your workers money. So salaries, wages, and it's $18,000. Expenses, again, when you recognize an expense, you debit it, and it's always assumed you're paying cash when you pay an expense. So you credit cash. Number 12, the firm paid utilities of $650. Utilities are another expense. I didn't change the dollar amount of this one. This is the blank issue. So some of you messaged me that when you would type in, it was blank. And that's something with how this was formatted. So whenever you're typing and something's blank, go up here. You could hit new normal to change the formatting. You want to try highlighting the cell to see if it brings the color on. I think this is the only problem that really has that as an issue. So anyways, we're going to do utilities. Come on. Utilities, expense. We're going to debit it, $650. It's an expense. See, there's another one. It was blank. Go up here. I'm going to put it to normal. You can see it. Put it to money. There you go. And then we're going to credit cash. You're paying it expense with cash. Number 13. Janet Young took a drawing of $2,000 for personal use. All right. Whenever an owner withdraws money from the business, it's the opposite of when the owner puts money into the business. So the business is going to be losing cash. So we're going to wind up crediting cash. And what you do when an owner withdraws money is you debit the account owner's drawings or owner drawings, however you want to really label it, $2,000. And you're going to credit cash $2,000. So that's journal entries. Notice I did the journal entries first, and that's why it's number 1 here. You don't do anything else on the accounting cycle. The ledger, the trial balance, you don't do anything before you do the journal. You don't do the ledger. You don't start putting stuff in here until the journal is done. Okay? Now, if you want, you could do the journal entry for number 1 and then update the ledger based on what you did for number 1. And then move on to journal entry number 2, update the ledger. Or you could do all the journal entries and update the ledger afterwards. That's what I'm doing here. So now that we did the journal entries, here's how you update the ledger. The ledger keeps a balance of each account. So it has all the accounts a company has: cash, equipment, supplies, accounts receivable. It takes everything that happened to these accounts in the journal entries and gets one total balance for them. So let's start with number 1. We debited cash in journal 1. Debited cash $500,000. So what do? You go to the cash ledger in the general ledger. The reference number for this case, normally the reference number is like a specific date. We're just going to put number 1 and mean journal entry 1. And what did we do to cash in journal entry 1? Did we debit it or credit it? We debited it $500,000. So we're going to put $500,000 there. And look, this updates for you the balance. So this is going to help us with the balance. Now, take your time. Don't skip to the next journal entry. Don't look for what you did to cash next because that's going to mess you up. Take it line by line. So we debited cash $500,000. Then we credited owner's capital $500,000. So find capital in the ledger. Reference number is still number 1. We didn't debit it. We credited it $500,000. Now go on to journal entry number 2. Don't go looking for more cash or capital. Go to journal entry 2. What happened in journal entry 2? We debited equipment $7,000. Go find equipment. Come on. Go find equipment. Journal entry 2, we debited it, $7,000. What else did we do? We credited cash in that journal entry 7,000. So journal entry 2, we didn't debit cash. Now we credit it $7,000, and it brings it down. Remember what I said, assets increase with a debit, decrease with a credit. So this credit brought the cash balance down. So this means we started our business with $500,000 of cash. Now we're slowly going down. We just lost 7,000. We spent it. We didn't lose it. We spent it appropriately. Number 3, we purchased equipment for $4,000. So we debited equipment 4,000. So reference 3, debited equipment 4,000. What did we also do in number 3? We credited accounts payable 4,000. Go find accounts payable. It's right here. Reference number 4. I'm sorry, reference number 3. We didn't debit it. We credited it 4,000. Number 4, we didn't do nothing for. Number 5, we debited supplies 1,500. Go find supplies. Put in the reference number 5. Debit it $1,500. Look at that. Then in number 5, we also credited cash 1,500. So go back up to cash. Do number 5 as the reference. Don't skip lines. Don't worry about skipping lines. We credited 1,500. Look at that. It dropped cash more. Notice how I'm not going through the journal entries and trying to look for each time we got cash. That'll mess you up because you'll miss something, or you could miss something. Instead, take it journal entry by journal entry. So now number 6, we debited accounts payable 500 back when we reduced what we owed. So I'm going to put reference number 6, and I'm going to put a $500 debit. Look at that. Credit, the liability accounts payable initially had a credit balance of 4,000 because they increased with a credit, but now we debited 500. Liabilities decrease with a debit. So what we owe is going down. If this was your credit card, you owed 4,000. Now it decreased by 500. Now you only owe 3,500. That's what that means. Number 6, so when we paid that account payable, we credited cash 500. So we're going to go up. Number 6 on cash, and we're going to put another credit entry of 500. Go down. Number 7, rent expense. We debited rent expense $5,000. Find rent expense over here. Number 7, you're going to debit it $5,000. How did we pay that rent expense? With cash. So we're going to go back up to cash. We're going to do number 7, and we're going to credit it 5,000. Okay, number 8, we received cash for $50,000. So we debited cash $50,000. Number 8, that's number 2. Number 8, we debited cash $50,000, and watch. Remember, debits increase assets, so our balance is going to increase $50,000. Again, this formula is built in. You don't have to do the formula, but just know when you debit an asset, you increase its balance. When you credit it, you decrease. Again, use the cheat sheet to help you with the other types of accounts. Number 8, when we debited cash, we also credited sales revenue. Here it's just listed as sales. So we're going to put $50,000. Number 9, we made another sale, but we recognize accounts receivable. So we debited accounts receivable $16,000. So number 9, debit accounts receivable $16,000. And then back to sales revenue. Number 9, made another sale $16,000. See, it increased $66,000. Go to number 10. We received cash. So we debited cash for $10,000 and we decreased our accounts receivable $10,000. So first we debited cash $10,000 more dollars. So number 10, $10,000 added to cash. And then we reduced that accounts receivable number 10. We credited it $10,000. So now look, the balance is only $6,000. That shows the customer only owes us $6,000 more dollars. Number 11, salary expense. We debited for $18,000 and then we credited cash for $18,000. So number 11, you're going to debit salary expense $18,000. You're going to go up to cash and credit it for $18,000. Number 11, $18,000. Number 12, utilities expense we debited for $650. Look at that, utilities right here. We're going to debit it $650, and we paid it with cash. We credited cash $650. So we're going to go up here. Number 12, we're going to credit it $650. Number 13, last one, we debited owner's drawings for $2,000 and we credited cash for $2,000. So first find owner's drawings, number 13, debited it for $2,000, cash, number 13, credit for $2,000. Number 13, credit for $2,000. So the ledger, we're not doing anything new. We don't have to do any figuring in the ledger. We just have to look at the journal entry and copy over to the ledger. And now if you look at all these accounts, again, the formulas were in there, so it updated them for us. So cash has a balance, an ending balance of $525,350. Equipment has an ending balance of $11,000. You go by what the balance is in the last filled in box. Supplies has a balance of $1,500. Accounts receivable has a balance of $6,000. Okay, this one was just blank. I'm not going to read through them all because we're going to wind up seeing them in the trial balance. So now the trial balance, what the trial balance does is it takes all your accounts and puts their ending balances, whether it's a debit or a credit ending balance, and it organizes them. And what it's supposed to do is it helps, one, if you're looking at a company, you can see the total cash, accounts receivable, their revenues, one line item, rather than having to look at all this. So it helps the users, and then it also helps the accountant make sure that the debits equal the credits. If they don't, that means something in the ledger or something in your journal entries is wrong. Okay, the debits have to equal the credits. So on the trial balance, what you normally do is you start by listing your asset accounts first. So I'm just going to start writing in cash. I'll write in accounts receivable. It's just the accounts you as a business have. So whatever this specific business had. Equipment's an asset, supplies are an asset. That's all the assets we had. Next, you normally put liabilities. So we only had accounts payable. Next, you put your owner's equity. Normally you do capital first. So owner's capital. Then you do owner's drawings. Then you do revenues. So we had sales revenue. Then you do expenses. So we had rent expense, salaries expense, and utilities expense. Okay. For many of you, and I think I sent out an email to everyone giving you a tip and a trick. When it comes to what kind of balance these accounts have, there's a trick. Assets, drawings, and expense accounts will have a debit balance in the trial balance. So you put their ending balance in the debit column. Liabilities, capital, and revenue will have a credit balance. But say you forget the trick. Here's how you know for cash. You had all this. You had debits and credits. So what's your balance? Just use your thought process. So if you look here, you can see your total debits was $560,000. You're using Excel. You could highlight them and it tells you your total was $560,000. So you debited cash a total of $560,000. You credited cash a total of $34,650. So which side's bigger? Your debit side. You had way more total value of debits than you did credits. So this 525, it's going to be a debit balance because your debits outweighed your credits. So you're going to debit cash 525, 350. Now you could use that logic throughout all equipment. You only had debits, so this $11,000 has to be a debit down in equipment. Supplies, you only had a $1,500 balance, so you would only debit it. Accounts receivable, you initially debited $6,000, then you credited $10,000. Your debit was higher than your credit, so $6,000 is still left in the debit side on accounts receivable. Or you could use my trick. Assets will have a debit balance. Accounts payable is a liability. It'll have a credit balance. I forget what that balance is. $3,500. So accounts are payable, since it is a liability, its balance is going to be in the credit column, $3,500. Owner's capital, we only touched once. We credited it for $500,000. That's what we're going to do right there. Credit $500,000. Owner's drawings, we only touched once. We debited it for $2,000. Or you could remember, drawings have a debit balance. Sales revenue, we had a few credits to it. It totaled $66,000. So revenue gets credited, 66,000. Rent expense, salary expense, utility expense are all expenses. So they're going to have debit balance. So salary, 18,000, utility, 650. And salaries, salaries was the 18,000. I didn't do rent yet. And rent was 5,000. All right, the big reveal. Once I hit enter, the total debit should equal the total credits. Bam. Ignore this check figure because that's for your assignment. Since I changed the figures, it won't be that number. But look, the total debits equal the total credits. If the total debits don't equal the total credits, something either was posted wrong in the ledger when you moved it over, or something in the journal entries wrong. There's no circumstance where it will ever be, here's a rare time where the debits should be more than credits or less than. It always has to equal. And again, you're going through, maybe you picked the wrong account for a journal entry, but just a rule, I never want to see a debit and a credit for an account in the trial balance. It'll have one balance or the other. It'll never have two. So even if your amounts wind up being wrong here because the accounts weren't used correctly, understandable while you're learning, not understandable right now that I'm telling you. So from this point on, I don't want to see a debit and a credit. I don't want to see a debit and credit for accounts receivable. It's one or the other. Again, technically, I don't want to see a credit balance for any asset account because I told you the trick. Assets will have a debit balance. Drawings will have a debit. Expenses will have a debit. Okay, so I don't want to see them in the credits at all. I'm telling you right now. Accounts payable, a liability, I don't want to see a debit balance for. I don't want to see a debit balance for an owner's capital because it's the capital. It has a credit balance. Revenue, I don't want to see a debit balance for. Okay? These are tricks. These things, this is how I know who watches this video. I don't want to get an email saying you don't understand where to put a liability account on the trial balance, debit or credit column. That just means you didn't watch this video. Okay? So watch it and pay attention. Take notes with it, just like a lecture. Now, after you do the trial balance, step 3, there's a reason these are in steps. First was journal entries, then you do number 2, the ledger, then number 3, the trial balance. You go to number 4, the financial statements. The financial statements are built from the trial balance. So, first, you always start the income statement. Always. Always, always, always. That's a rule. First, on the income statement, you list your revenues. If you had multiple revenues, you would list them all. We only have one revenue, and it's the sales revenue. So we'll just put the total sales revenue amount, 66,000. Now you list your expenses. You list them. Don't just put a total since we have multiple. So we're going to write rent expense. Actually, there's no assignment really based on this, but when it comes to listing your expenses on an income statement, you list them in order of highest to lowest. So we're going to do salaries, rent, utilities. I won't grade wrong for that, but it's just something good to know if you plan to go into accounting. Utilities. Okay? And you're going to put them over here. All right, so whenever you have multiple, you put it in the left column, and then you total it in the right column. So salaries were 18,000. See, we have another blank cell. So I'm just going to go up here. I don't know why it's built like that. I'm just going to hit normal. Rent expense was, I'm not going to be lazy. I'm just going to go look. I was almost lazy. $5,000. And then utilities were $650. So your total expenses, now you have to do your own formula. It's just the sum of all your expenses. Okay, I hit the wrong button. So it's the sum of all these, and then close your parentheses. Make sure you hit the right button. So this is our total expenses. Net income. A company's net income is what they earn from their revenues minus their expenses. So net income is going to be this total revenue minus the total expenses. So they had total income, net income of $42,350. Next, you always, from the income statement, move on to the statement of owner's equity, sometimes called the statement of retained earnings. And the first thing you do is you list your beginning capital, your beginning equity. That beginning capital is your capital figure on the trial balance. So $500,000. Next, what you do is you add your net income if you had a net income. Some companies, they could do bad and they could have a loss. Their expenses are more than their revenues, so they would have a negative figure here. If they had a loss, they would subtract their loss. Okay, but they have an income. They have a positive number, so they're going to add it. So we're going to list 42,350. It's invisible again. So again, just come up here. It shouldn't be like that. 42,350. Then you're going to do a subtotal. So you're going to show currently where you stand. So with your net income plus beginning capital, you're at 542,350. Then you subtract your owner's drawings. Owner's drawings get subtracted from your capital balance. So you could put it as a negative, but you don't have to. You just know that you subtract it. So our owner's drawings again were $2,000, I believe. Yep. So we're going to put $2,000 here. We just have an empty blank line. So your ending equity is going to be this subtotal minus the owner's drawings. So we got 540,350. That's our ending equity. Now we go to the balance sheet. And the balance sheet is just listing our assets, liabilities, and then the ending equity. Ending equity is what we just calculated. This is why we do the balance sheet last. So first, start by listing your assets. So for this company, they had cash, they had accounts receivable, they had equipment, and they had supplies. And now we're going to go see what their balances were. I can't remember. Cash was 525,350. Okay. Or you could do equals and then click up there. Accounts receivable was 6,000. Equipment was 11,000. And then supplies 500, 1,500. So this totals it for you. So your total assets are 543,850. If it didn't, you would just write total assets and do your own total. Okay, do the sum of all these. Now you list your total liabilities. Look, the assignment already has accounts payable there. List your liability. So accounts payable, put the balance of it. It's 3,500 right now. Again, everything's positive on the balance sheet. You don't put negative. Again, this isn't a negative balance. A liability has a positive balance when it's credited anyways. So you put the figure there. There's no other liabilities for this company. So then you move on to equity, but you don't put the beginning capital, that 500,000 from the trial balance. You use the figure you calculated, the ending figure. So 540,350. It adds for you your ending equity with your total liabilities. So there was only one liability, so 3,500 was the total liability. There is the ending equity, 540,350. Added together, you could put total liability and equity, total L&E. You could write it out. 543,850. This is the accounting equation. Assets equals liabilities plus owner's equity. Assets 543,850 equals liabilities plus owner's equity of 543,850. These two figures will always, 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 always match if it's right. If they don't match, something's wrong. Either something was calculated wrong up here, something was wrong in the trial balance, something was wrong in the ledger, something was wrong in the journal entry. There's never going to be a rare circumstance where maybe the assets are more than the combined liabilities and equity. Never. Can't happen. Accounting is built to help you find mistakes. So these two will always, always, always match. And notice, we only use accounts once from the trial balance. Okay, so owner's drawings, it is technically an equity account. Revenue and expenses are equity accounts. Okay, they're just a branch of equity, but we don't put them in equity here. We use them once. So revenues and expenses were used in the income statement. They're done. drawings was used in the statement of owner equity, it's done. So accounts will only be used once. Don't put them twice. Okay. So that's this video going over this assignment that I created that is very, very, very similar to the assignment you had in week 2. Okay, use it to help you. Watch the assignment. Get it. Yeah, have excitement as you watch the assignment. But don't come to me and say you're completely, totally lost. It's one thing, again, if you're looking at a transaction and the firm pays salaries $18,000 for the month, you don't know what accounts to pick out of that. Okay, that's understandable. It helps to look at the cheat sheet and say, okay, if we're paying salaries, let's see, there's an account on the cheat sheet called wages expense. That's a salary. Um, when you're paying someone a salary, you're usually giving them a check or cash. A check is cash, so cash is affected. But I never want to see from this point on, if I do, I know this video is not watched by whoever I see this from, a journal entry that doesn't have a debit shifted to the left, a credit shifted to the right, both a debit and a credit that equals each other. Okay. I don't want to see any of the rules I've talked about. Okay. I don't want to see things in the same line on the ledger. Okay. I don't want to see that in the journal entry. You debited cash, but for some reason you put it in the credit column here. You just copy it right over the same. So all these tips and tricks in this video, please watch, pay close attention. You can watch it many millions of times, free of charge. Okay, watch it, watch it, watch it. And then if you watch this video and you say, hey, why did you debit accounts payable number 6 and credit cash? I just don't get it. Email me that. That's a great question, and I will go over that. And while I'm talking about this, don't just email me that you're confused. Like, don't just say, I'm confused on journal entries. Well, are you confused on every single aspect of journal entries? Because that's a very long response. If you're just confused on the setup of journal entries, one little aspect of them, specify that. Because this way it saves you time and me time if you're just confused on one little thing rather than the whole thing. And if you are confused on everything, even from the ground up, honestly, my response is going to be when you watch the videos I send out, what loses you in the video? Okay, so if you watch the video on how to make journal entries and I go over, you put debits on the left, credits on the right, debits on top, credits on the bottom, debits have to equal the total credits. What part of that lost you? That's what I'm going to ask. And I'm going to ask it just so I know specifically one, that you watched the video. If you didn't watch the video, you're wasting your own time because why are you even trying? And you're wasting my time. Now, if you watched it and then you say to me specifically, I just don't get how you choose what went to the debit column. Great question. I will answer that. But if you just say, I'm just lost, I don't know where to go with that. Okay, so send me specifics. But again, if it's a specific thing and you say, how do I know if cash on the trial balance goes in the debit or credit column? I'm going to say, did you watch the video where I say assets go in the debit column? Okay, so some things are answered. You just got to pay attention and take notes, watch, rewatch. All right. Um, so go ahead, watch this. Send me any questions. I don't know if I'm ever going to use this video again, so I don't want to specify for this class. Just have a happy holiday if I do send this out in the future. Um, if there's any holiday upcoming, happy holidays. And I hope everyone's well and safe.